Australia's housing market isn't just expensive, it's under siege. Construction costs are climbing faster than inflation, tradies are vanishing, and even concrete, the literal foundation of every home, is in short supply. If you're a property investor, this isn't background noise, this is your bottom line being squeezed. Let's break this down. Across most of the country, the cost to build a new home is surging, and not by a little. In Tasmania, average construction costs have jumped 9.2% in just 12 months, now sitting at around $427,000. South Australia isn't far behind, $424,000 on average, up more than 8%. To put that into perspective, inflation's running at about 3.8%. So, for every dollar inflation adds, construction's adding too. For investors, that's a problem. Higher build costs mean thinner margins, tighter returns, and for developers, potential project delays or cancellations. But the story doesn't stop at price tags. Let's look at why this is happening. Australia's trade workforce is stretched to breaking point. We're short an estimated 10,000 tradies just to meet upcoming demand, and there's no quick fix in sight. Every missed apprentice intake, every worker who retires or leaves the industry, adds to a snowballing shortage that's now hitting investors directly. What does that mean in real terms? Longer build times, more expensive labor, higher holding costs. If you're a builder or developer, you're paying interest on land while waiting for a crew that might not show up for months. Even small projects are being pushed back, forcing investors to either delay settlements or absorb inflated construction contracts. And while this might sound grim for anyone looking to get into the building trades, it's the opportunity of a lifetime. The industry's crying out for workers. If you've got the skills or the willingness to learn, the next decade could be one of the most lucrative in construction history. Now, let's talk concrete, because this is where things get seriously messy. South Australia, for instance, is staring down a full-blown concrete shortage. Massive infrastructure projects like the $15.4 billion Torrens to Darlington project are swallowing up supply at a pace smaller builders can't compete with. And when you're at the end of the queue for concrete, prices spike. It's simple supply and demand, except the demand is now government-funded and locked in for years. Throw in the upcoming Women's and Children's Hospital, and the squeeze gets even tighter. Residential builders are effectively fighting giants for scraps, and that means more cost blowouts, more delays, and more risk for investors. Remember the timber shortage during COVID? We saw the same story. Projects stalled, budgets shattered, and smaller builders pushed to the brink. Concrete is now shaping up to be the sequel, only this time it's hitting just as population growth and housing demand are accelerating again. Here's the truth most headlines miss. Inflation isn't the main driver of these soaring costs. It's the structural issues underneath. Freight and import expenses are biting harder in states like Tasmania and the Northern Territory. Labor shortages are compounding with material bottlenecks. And even as supply chains heal post-COVID, build times are still lagging behind pre-pandemic norms. So when we see construction costs up 9%, that's not just prices rising, it's capacity shrinking. And when capacity shrinks, investors lose options. You can't just pivot to another builder if everyone's booked out 6 months in advance. For property investors, this moment demands strategy, not panic. Yes, costs are up, but so are rents. The shortage of new builds is actually tightening housing supply, which supports property values and rental yields. So, while builders are hurting, owners and landlords who already hold assets in high-demand areas may come out ahead. But if you're planning to build or develop, it's time to rethink your timelines and your budget assumptions. A 4% contingency fund isn't going to cut it anymore. Think 10 to 15%. Lock in contracts early, verify material availability, and if you're partnering with a builder, make sure they've secured supply chains, not just labor. And one more thing, watch government infrastructure rollouts in your area. If a multi-billion-dollar project is breaking ground nearby, expect ripple effects through your local construction ecosystem. That might mean delays, but it could also drive future growth. New roads, new jobs, new demand for housing. Australia's construction sector is in flux. Yes, it's chaotic, but periods like this, where fear and frustration dominate headlines, often mark the turning point for savvy investors. Because while costs rise today, what's really happening is a capacity reset. And when the industry rebounds, it'll do so fast. So the question isn't, is it too expensive to build? It's how can I position myself before the next wave of demand hits? Tradies are stretched thin, concrete is running dry. And yet, demand for housing keeps growing. This chaos isn't just noise, it's the sound of opportunity for those paying attention. Because when the dust settles, investors who understand these pressures and plan around them won't just survive the storm, they'll own the rebuild.